What's good, guys, and welcome to the Investment Bible. Today we'll be talking about some of the stocks that Mark Cuban is holding and why he's raising more cash. If you're not familiar with Cuban, he's best known for being an angel investor on Shark Tank. He's also the owner of the Dallas Mavericks. He's a huge advocate of a buy and hold investment strategy as opposed to just day trading or swing trading. He's focused on the long term and less concerned with his investments on a day-to-day basis. Cuban follows what he calls the number one rule of investing. When you don't know what to do nothing. However, despite the market downturn, Cuban recently re-upped on a few of his favorite stocks and is sticking to a few of his core holdings, which we'll get to later in this video. Let's take a look at the S&P 500 ETF SPY. From February 19th to March 23rd, where the market had bounced, the S&P lost roughly 34% of its market cap. As you can see, the market has semi-recovered as of yesterday and has cut its losses in half. During this time, while everyone else was selling, Cuban was buying. Cuban purchased shares in the exchange-traded fund SPY, which tracks the S&P 500. It's an index of the top 500 largest companies listed in the U.S. He also scooped up shares of the company Live Nation. Live Nation is traded on the New York Stock Exchange under the ticker symbol LYV. Looking through Live Nation's investor relations page, we find that it's a world-leading live entertainment company and operates under three segments: Ticketmaster, Live Nation Concerts, and Live Nation Media and Sponsorships. Roughly 82% of their revenue comes from their concert events and 13% from their ticketing sales. So you're probably wondering why someone would invest in a company that just halted its slate of worldwide concerts and whose stock saw a plummet of nearly 62%. Well, Cuban's investment came not long after Live Nation's CEO Michael Rapino bought 1 million shares of his own company, and James Caan and the board of directors at Live Nation purchased over $100,000 worth of shares. That's not to even mention the many other executives who intelligently bought their stock at a deep discount. Within just a few weeks, Cuban and Live Nation's executives' investments paid off. Had they had bought on March 18th, where Live Nation bottomed, which Mark Cuban claims to have done so, then their investment, assuming they did not sell at the peak, would have returned them 30% as of yesterday. So, was this a swing trade or a long-term play for Mark Cuban? The unique situation that Live Nation has found itself in is likely not permanent. The pandemic will likely pass, and the 270 venues that Live Nation operates will eventually open again. No one can say for sure whether Cuban's intentions were to quickly flip the stock for a profit, but he now has the opportunity to take a portion off the table or hold for the longer term. After all, he is a position trader. With the long-term potential still intact, should investors add Live Nation to their portfolios? Well, before the COVID-19 pandemic, Live Nation was a stock market winner, having soared from a price of $10 per share at the start of 2013 to over $70 per share at the start of 2020. Driving investor enthusiasm has been a compelling growth story of rising concert attendance. One strong consumer trend has been an increasing preference to spend money on experiences rather than physical possessions. Live Nation is at the heart of this consumer trend. Looking at the company's income statement on Yahoo Finance, they made $10.3 billion in 2017 and gradually increased their sales to $11.5 billion in their last reported fiscal year 2019. An important metric to assess the risk of a company, especially in times of uncertainty, is its net leverage. Net leverage tells us how well a company will be able to pay off its debt using cash and its earnings. The equation is quite simple actually. Total debt minus cash divided by EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. EBITDA is simply a proxy for a company's cash flow. So let's use this equation to figure out Live Nation's net leverage. First, we have to look at the balance sheet and scroll down to long-term debt. Shown here, it's about $3,271,262,000. Then we got to find current debt, and if you scroll up, it shows that it's about $38 million. Adding these both up gives us our total debt. Scrolling up, we'll find the company's cash total of $2.47 billion. Subtracting that number from the total debt gives us, you guessed it, net debt. Now we have to bounce over to the income statement to find the company's EBITDA. Scrolling down, it shows us that it's 786 million, and we divide this number by the previous and have now found what we wanted, our net leverage. So this number shows how many years it would take for a company to pay back its debt if net debt and EBITDA or earnings are held constant. In this case, it would take Live Nation about a year to pay off all of its debt. A good number depends on the type of company, but a ratio higher than 4.5 or 4 would set off red flags for me. It really just depends on your risk preference. The lower the net leverage, usually the better. Companies with higher debt to EBITDA ratios are less likely to take on more additional debt required to grow, at least in an organic way. I won't be doing this, but you can also compare the net leverage to previous periods to see how their ability to pay has gotten better or worse. As a side note, in this specific case, we know earnings are likely not going to grow for fiscal year 2020. Many of the concerts that people have prepaid for have been refunded due to the problems surrounding the coronavirus. So they'll be less able to pay off that debt, and that number will likely be higher in the future. While we could look at a million other financial metrics, all in all, in terms of a good investment, it seems that Live Nation can sustain its current debt load and will likely reap the benefits of all this pent-up demand down the line. Cuban's got his hands on a pretty solid company at the moment. Cuban came out Thursday to say that he's been increasing his cash position since he knows that the uncertainty in the market. Having liquid assets now will allow him to buy new stocks or add to the positions he already holds. I'll now pass you along to dive into one of Cuban's favorite companies to own right now, Netflix.
All right, guys, next we're going to go into Netflix. As we all know, Mark Cuban's been a bull on Netflix for a long time, thinking it's going to continue to disrupt the filming industry. What we're going to do here is take a look and see if we think Netflix is also viable for an investment. As we know, he's a long-term investor, so he's not looking for the swing trade, obviously. And it's going to show Netflix has been one of the best investments in the S&P. Netflix was started in 1997 by this guy on the left here, Reed Hastings. It's come to find out he got sick of Blockbuster fees when he was hit for a $20 fee for returning a movie that was a couple days late. What he did was completely change the business model and put Blockbuster out of business. Blockbuster had the chance to buy Netflix back in around 2004, but they denied and just scoffed at the idea that Netflix was actually going to continue to take away their market share. Little be known, this dinosaur here we have left on the right has completely gone out of business, except has one store in Alaska left that offers basically just a museum to look at people back when they were kids. Since Netflix IPO'd at $1 a share back in May in 2002, it has skyrocketed to over $370 a share currently, and has been bouncing around between these $400 and $300 levels. What's determined to see is what's going to happen to Netflix in the next coming years, and that's what we're trying to figure out. Since then, Netflix has gone up an insane amount of 33,000%, being one of the best performers in the S&P since 2000. It's been an absolute rocket since then and has only been outperformed by a certain few amount of stocks. So let me look at why have they been so successful? Well, initially it was the complete business model disruption. Before then, you had to go to a store, rent a DVD, bring it home, and bring it back to the same exact store. And if you didn't bring it back by a certain day, you were hit with late fees. Late fees are how companies like Blockbuster made a majority of their revenue. What happened was Netflix took advantage of the postal service and set up distribution centers around the country, mailing DVDs to their customers, and all you had to do was drop them in a mailbox and get them back. One of the biggest kicks for Netflix was they didn't have late fees. You just paid a monthly subscription fee, and that's also where it came in. Innovation, which they had. Subscription was a new platform at the time, and not a lot of people took advantage of it, but Netflix did, and subscribers were huge. Another thing they did is Netflix was huge to get into the DVD industry compared to most places were using VHS tapes at the time. Then what happened is they were able to license these DVDs for very cheap prices and get a huge content library, and they had no problem between DVDs. At the time, if Blockbuster had movies, they didn't have enough, they'd have to ship movies between stores. Very costly, very inefficient. If you went on Netflix's website, bought a DVD, it would just come from a distribution center right in the mail. This was very efficient and very quick. Because of this, they have a market share dominance today. 75% of TV-based video streaming in the US is Netflix, and they're the world's most popular video streaming service globally, with over 160 million subscribers to date. Another important thing they've done is they've transitioned their business model into the streaming. And with the streaming, they've been able to come up with a lot of originals. But it's important to keep in mind, some of these originals they have not actually owned, they've licensed them. And that's important to think about when you think about the costs associated with these and the lifespan of them. The biggest release they just released was Tiger King, and it's been a hit so far. So if they keep pumping out hits like this, it's going to be interesting to see in the future. But we're going to look into the financial aspect of this coming up. What's the cost of all this content creation and licensing to get customer acquisition? Well, if we look here, their top and bottom line has been growing over the past 5 years exponentially. Their operating margin has almost tripled in 5 years, and the revenues have gone from $6 billion in 2015 to $20 billion in 2019. Earnings have also gone up about 20-fold from 2015, where earnings per share was 28 cents compared to $4 in 2019. And then another thing investors have been paying attention to is global streaming paid net membership additions. What this means is how many customers they're getting on a yearly basis subscribing, because, like we said, subscription is the main way they drive their revenue. But this is where the but comes in. It's important to realize here what Netflix is doing. They are buying all of this content and leasing it, and they are capitalizing it. They are not expensing it. What that means is it does not run on their income statement. It only runs on the cash flow statement. Their net income is jumping drastically because they're pumping out incredible amounts of debt and then taking the contents and keeping that on their asset sheet, on the asset side of the balance sheet, and then they're writing it down on a yearly basis. So what does this mean for Netflix? They've been getting a lot of content, but they've been running up their debt. If you look down here, their debt in 2015 was a little over $2 billion. Come to 2019, their debt is over $14 billion. Why? Because they've been dishing out money in capital markets in order to try and fund their content. What Netflix is thinking behind this is they're going to use all this debt and all this leverage to create more content and get more subscriber growth. Because that's the only way they're going to be able to repay this debt, because they need people to sign up for the platform to get more monthly revenue. In my opinion, this is going to be very hard for Netflix to do with a bunch of competitors coming into the industry. Competition's getting too high and barriers to entry are too low for all these firms that already have means of production. All they have to do is put it online. Disney Plus just reached the 60 million subscriber mark in less than a year, even less than 6 months. YouTube TV, NBC, HBO, and Prime Video, they're all getting into the space. Netflix has had the first mover advantage, but now that these other firms are getting involved, it's going to be way harder for them to stay on top.
Hope you guys enjoyed, and thanks for watching.